In this video, I'm going to talk about how long the IRS has to fine you if you do something wrong with your taxes. Fortunately for taxpayers in the US, there's a limit to the IRS's ability to come after taxpayers. And there's two components to this. There's a statute of limitations that applies to the IRS's ability to assess a tax deficiency for prior tax years. Basically, the IRS can usually just go back 3 years, although there are exceptions which I'll talk about momentarily. Now, there's also a statute of limitations which has to do with the IRS's ability to collect back taxes. So collecting, that has to do with when the IRS has already assessed a tax deficiency and said you owe this money. And this has to do with a statute of limitations, typically 10 years, that the IRS has to go and collect that money. Although there are exceptions with that as well. In this video, I'm going to talk specifically about the statute of limitations for the IRS to go and do an audit and come and assess a tax deficiency for a prior tax year. I'll make a different video where I talk about the IRS's limits in terms of collecting unpaid back taxes. Okay, so right now we're going to talk about the statute of limitations for the IRS to assess a tax deficiency for a prior tax year. So we're going to be talking about the assessment statute expiration date, which is what the IRS refers to it as. It's covered under Section 6501 of the tax code, and that says that a tax deficiency must be assessed within 3 years of the later of two dates. The date that the tax return was actually filed by the taxpayer, okay, so we've got the filing date, or the unextended due date of the return. So you take this date, you take this date, and the later of those two dates, you go forward 3 years from that, and that is the statute of limitations, okay, unless an exception applies. So before we get to the exceptions, let's do a basic scenario. Tom's tax return, let's say, is due on April 15th, 2024. So that's just the normal date that Tom's tax return is due, and this is tax return for the 2023 tax year, let's say. Okay, so that's due April 15th, 2024. Tom files early. Tom files on March 1st, 2024. So I had said that the tax deficiency must be assessed within 3 years of the later of when it was filed or the unextended due date. Here, the unextended due date was April 15th. It was filed on March 1st, so the later of those two dates is April 15th. So it's going to be 3 years from that date. So the IRS has until April 15th, 2027 to assess a tax deficiency unless one of the exceptions applies, which we'll get to. Okay. But now, before we get to the exceptions, what if Tom had obtained an extension? So let's say, so the unextended due date was April 15th, 2024. But what if Tom had got a 6-month extension so that Tom's taxes were actually due October 15th, 2024? So what then, how would it work? Okay, so if Tom had got an extension to October 15th, 2024, and then let's say Tom actually filed the taxes on June 1st, 2024, you go back and again, you look at the unextended due date, which was April 15th, and you compare that to the date that the return was actually filed, which in this case, Tom was filing June 1st. So the later of those two dates, in this case, it's June 1st, right? We ignored that. This doesn't matter, the date that he actually had to, because that was the extended due date. It's the unextended due date compared to the date the actual return was actually filed. It was actually filed June 1st. That was later than the unextended due date. So 3 years from then, so June 1st, 2027 would be, so that's the time period that the IRS would have to go back and audit his tax return for the 2023 tax year. Now, I said there were exceptions to the 3-year rule. One of the exceptions is if Tom had omitted gross income that exceeded 25% of the gross income he actually reported. So for that tax return for that 2023 tax year, let's say that Tom had reported gross income of $100,000 and he had actually omitted, like he had not reported income that should have been reported, $45,000. So then we say, okay, of the gross income he actually reported, 45% there was missing, so to speak. Okay, so he omitted more than 25% of the amount of gross income he actually reported, the amount that the IRS says he omitted. That allows them to go back 6 years instead of 3. So basically, if you omitted a lot of gross income, they can go back 6 years instead of 3. Now, if Tom or whoever the taxpayer is, if you actually file a fraudulent tax return, so we're not talking about you made a mistake or you misunderstood the tax code, you committed tax fraud in filing your return, then there is no statute of limitations. The IRS can always come after you if you filed a fraudulent return. Also, if you didn't file any tax return at all. So if you were being cute and you're like, hey, you know what? I'm not going to report any of this income. I'm not even going to file a tax return, and I'll just wait 3 years. And then if they don't get me in 3 years, then I guess I'm off scot-free. That's not the case. There's no statute of limitations if you didn't file a tax return. So if you filed a fraudulent return, if you didn't file a return at all, the IRS can always come after you. Now, in some cases, the taxpayer and the IRS will actually reach a mutual agreement to extend the deadline for the statute of limitations. So if you file Form 872 and you indicate, both you and the IRS have mutually agreed to extend the deadline, then that can go beyond the 3 years as well. Also, you can have a situation where, let's say, a taxpayer is unable to manage their financial affairs. I mean, I just think off the top of my head, let's say you had a taxpayer that's in a state of a coma, right? They're in a hospital, they're in a coma or something. For some reason, they can't manage their financial affairs. That time period can be extended suspended. Also, the time period can also be suspended in certain cases when the taxpayer has filed bankruptcy. So general rule, 3 years. If you omitted a lot of gross income, 6 years. You committed fraud or you didn't even file a return, the IRS can always come after you.